could pay your insurance premiums for years, file one legitimate claim, and still get nothing. Your car gets wrecked. A pipe floods your home. Thousands of dollars in property disappear. You file the claim believing you're covered. Then two words appear on the letter: claim denied. But here's what most people don't realize. A claim can be denied because of something you did before the damage happened, while filing the claim, or even after the loss. And some of those mistakes are surprisingly easy to make. In this video, we'll break down 7 reasons insurance claims can get denied, how those reasons could cost you thousands of dollars, and what you can do if you believe the insurance company got the decision wrong. And stay with me through number 7, because one wrong statement during a claim can potentially turn a simple coverage dispute into a much bigger problem. Before we begin, this video is for general educational purposes only. Insurance policies and state laws vary, and nothing here should be considered legal, financial, or individualized insurance advice. Let's start with one of the biggest misunderstandings in insurance. Having insurance does not mean you're protected against everything that can happen. Insurance is a contract. That contract defines what losses are covered, what losses are excluded, how much the insurer may pay, and what responsibilities you have as the policyholder. Imagine a homeowner walks downstairs one morning and discovers water throughout the basement. The carpet is soaked, furniture is damaged, boxes of belongings are sitting in water. The homeowner thinks, "I have homeowners insurance, water damage should be covered." But there's a problem. Where did the water come from? If a pipe suddenly burst inside the house, the coverage analysis may be very different from water entering the property because of an external flood. The damage might look almost identical, but the cause of that damage can completely change how the policy responds. The same principle applies to auto insurance. Suppose you only carry liability coverage. You lose control of your vehicle, hit another car, and badly damage your own vehicle. You might assume your auto insurance will repair both cars. But liability coverage generally exists to address your legal responsibility for injury or property damage to others subject to the policy. It generally isn't the coverage that repairs your own vehicle after a collision you caused. For that, collision coverage is typically relevant. So when a claim isn't paid, don't start with, "Why isn't my insurance paying?" Start with a better question. What specific coverage in my policy was supposed to cover this loss? That distinction matters, because sometimes the problem isn't that the insurer refuses to pay. The problem is that the coverage needed for that particular loss was never purchased, and that brings us to another major reason claims can be denied. Exclusions. Insurance policies don't only tell you what they cover, they also tell you what they don't cover, and those exclusions can completely change the outcome of a claim. Imagine your roof starts leaking. You notice water stains spreading across the ceiling, and eventually you discover significant roof damage. You file a homeowner's claim expecting the insurer to replace the roof. But an inspection concludes that the roof wasn't suddenly damaged by a storm. Instead, it had gradually deteriorated over many years. That can be a very different insurance situation. Insurance generally isn't designed to function like a maintenance plan. A roof damaged suddenly by a covered windstorm may be treated differently from a roof that simply reached the end of its useful life. This is why one of the most important questions after a loss is, what actually caused the damage? Not simply, what is damaged? The cause can determine whether coverage applies. So if your insurer denies a claim because of an exclusion, don't stop at the words, "claim denied." Ask which exclusion they're relying on. Ask where that exclusion appears in your policy. And ask how the insurer believes that language applies to what actually happened. Get the explanation in writing whenever possible. Now let's talk about something that seems harmless, but can make a claim much more difficult. Waiting. Imagine a pipe starts leaking behind your kitchen wall. You notice a small wet area, but you're busy. You think you'll deal with it next week. Then next week becomes next month. By the time you report the problem, the damage is much worse. Now there may be mold, damaged cabinets, ruined flooring, and moisture inside the walls. Insurance policies commonly contain duties that apply after a loss, including requirements involving notice. And delaying a claim can make the insurer's investigation much more difficult. Evidence can disappear. Damage can become worse. A vehicle might be repaired before an adjuster sees it. Security footage might be deleted. And it can become harder to determine exactly what damage resulted from the original event. That doesn't mean every delayed claim is automatically denied. Policy language and state law matter. But unnecessarily waiting creates a problem you don't need. When something significant happens, document it and notify the insurer promptly. And keep a record of when you reported it. The next reason is one of the easiest to avoid. Incomplete or inaccurate information. Insurance claims depend heavily on documentation, dates, photographs, receipts, repair estimates, police reports when applicable, descriptions of what happened, information about damaged or stolen property, and sometimes statements from the people involved. If important information is missing, the insurer may not have enough evidence to determine whether the loss is covered or how much should be paid. But inaccurate information can create an even bigger problem. Imagine you report that a television was purchased last year. Later, records show that it was actually purchased 5 years ago. Maybe you simply remembered incorrectly. But now, the insurer may need to ask more questions. Or imagine you describe a car accident one way during the first phone call, then provide a materially different version later. Again, that can complicate the investigation. This is why accuracy matters. If you don't know something, don't guess. If you aren't sure of the purchase date, say that you're not sure. If you discover that something you previously provided was incorrect, correct it promptly. And don't inflate values because you assume the insurer will negotiate them downward. Your claim becomes stronger when your documentation is consistent, specific, and supported by evidence, not when the numbers are exaggerated. Now imagine something even more frustrating. The loss would normally be covered. You bought the right type of insurance. There isn't an obvious exclusion. But there's still no coverage. Why? Because the policy wasn't active when the loss occurred. Suppose an auto insurance premium isn't paid. The policy eventually gets canceled according to the applicable rules. Then an accident happens after the cancellation. Paying the premium after the accident generally doesn't simply turn the clock backward and make the loss covered. This is why cancellation notices matter. Automatic payments fail. Credit cards expire. People change banks. Emails get ignored. Letters get thrown away. And sometimes policyholders don't realize there is a problem until they need the insurance. So check your payment method. Keep your contact information updated. Read notices from your insurer. And when switching companies, make sure the effective dates line up correctly. Because even a short gap in coverage can become extremely expensive if something happens during that gap. Now let's move from what happens before a loss to what you do immediately afterward. Suppose a storm breaks a large window in your home. Rain starts entering the room. You photograph the damage and report the claim. But then, you leave the opening exposed for several days. More rain comes in. The flooring becomes saturated. Furniture is damaged. Water spreads into another room. Now there's a new question. How much of the damage came from the original storm? And how much happened afterward because the property wasn't reasonably protected? Policies may require policyholders to take reasonable steps to prevent additional damage after a loss. That doesn't mean putting yourself in danger. Don't climb onto an unstable roof. Don't enter a building that may be structurally unsafe. Don't attempt dangerous electrical work. But when it's safe, reasonable temporary measures can matter. You might cover a broken opening, move undamaged belongings away from water, arrange emergency water mitigation, or shut off the water supply after a pipe breaks. Before changing anything, photograph and video the original damage when possible. Keep receipts for reasonable emergency expenses, and be careful about making major permanent repairs before the insurer has had an opportunity to inspect the loss. Your goal is to prevent the situation from getting worse while preserving evidence of what actually happened. And now we reach number 7. This is where a normal claim can become much more serious. Misrepresentation or suspected fraud. Insurance companies investigate claims. And if information appears intentionally false or materially misleading, the consequences can go far beyond simply receiving a smaller payment. Imagine someone owns an $800 laptop. After a burglary, they report it as a $3,000 professional workstation, or they add items to the claim that were never stolen. Or their car already had significant damage before an accident, but they knowingly claim all of that damage occurred in the new collision. That isn't aggressive negotiation. That can potentially become misrepresentation or insurance fraud. And here's something people need to understand. You don't make a legitimate claim stronger by exaggerating it. You make it more vulnerable. If you don't know the exact purchase price of an item, say so. If you don't have the receipt, ask what alternative evidence the insurer will accept. Maybe you have photographs, bank statements, credit card records, emails, online order history, warranty documents, or other evidence showing that you actually owned the item. If something was already damaged before the loss, don't hide it. Accuracy protects your credibility, and credibility becomes extremely important when thousands of dollars are at stake. Now suppose you've done everything correctly. You reported the claim, you provided the documentation, you believe the policy covers the loss, and the insurer still denies it. What happens next? First, don't respond emotionally. Start with the denial letter. Read the exact reason the insurer gave. Then pull out your policy. Look for the coverage provision, exclusion, condition, endorsement, deductible, or limitation the insurer says applies. If the explanation isn't clear, ask questions. Ask the insurer to identify the specific policy language supporting the denial. Then start building your file. Keep the denial letter, your policy, photographs, videos, receipts, repair estimates, inspection reports, emails, claim numbers, and notes from important phone conversations. If you're challenging the decision, focus on evidence. Instead of writing, "This is ridiculous, you owe me money," write something specific. For example, the denial states that this exclusion applies. My documentation indicates that the damage resulted from this event. Please explain how the cited exclusion applies to these facts and review the attached evidence. That's a much stronger position. You're not simply expressing frustration. You're identifying the disagreement and creating a written record. If new evidence changes the insurer's decision, ask for the updated decision in writing. And if you still believe the claim isn't being handled according to the policy or applicable insurance rules, another option may be your state's Department of Insurance or insurance regulator. The exact complaint process and what the regulator can do varies by state. But knowing that the process exists is important. And that brings us to the biggest lesson in this entire video. The best time to understand your insurance policy isn't after something goes wrong. It's before the claim ever happens. Know what coverage you actually purchased. Know your deductibles. Understand major exclusions. Keep your policy documents somewhere accessible. Create a home inventory. Take photographs of valuable belongings. Keep records of major purchases. And review your insurance when your property or circumstances change. Insurance isn't a promise that every bad event will result in a check. It's a contract that responds to specific covered losses under specific conditions. So remember the 7 reasons we covered. The loss may not fall within the coverage you purchased. An exclusion may apply. You may have waited too long to report the loss. Important information may be missing or inaccurate. Your policy may not have been active. You may not have taken reasonable steps to prevent additional damage, or the insurer may believe the claim contains material misrepresentation or fraud. And if your claim gets denied, don't automatically assume the insurer is right. But don't automatically assume they're wrong either. Read the denial. Compare it with the policy. Gather your evidence. Ask specific questions. Document your communication. And use the review or complaint options available to you when appropriate. Because with insurance, the most expensive sentence isn't always, "Your claim was denied." Sometimes it's, "I never understood what my policy actually covered." If this video helped you understand the fine print behind insurance claims, subscribe to Fine Print Files. We break down U.S. insurance, claims, coverage, and the financial details that are easy to overlook until they cost you money. And in the next video, we'll explain exactly what to do after an insurance claim is denied, how to challenge the decision properly, and what evidence can make your case stronger.